everyone. My name is Clément Gignac, Senior VP and Chief Economist for our Financial Group. So over the next 5-7 minutes, I will try to summarize the webinar that we have just recorded with my colleague Alexandre Morin, who's in charge of the desk on the fixed income here at IA. So, the title of our webinar, in fact, was with all the trade tension and the falling interest rate, do we fear a recession coming? So the good news, I want to surprise people, we are not ready yet, at least to call a recession. Nonetheless, we have to be realistic. We have a significant deceleration of the global economy. And even some countries now, like Germany, is on the eve to experiment recession. In China, for example, this is the lowest economic growth in 27 years. So we have all this indicator of deceleration economy. This is the big difference with last fall. Last fall, the market have a concern. They dropped by 15-20%, but it was due to interest rate increase because the big picture was pretty good. Right now, we have a situation that you have a huge deceleration of the global economy. Among the reason to explain this deceleration is all this trade tension between U.S. and China. You know, this is the first time in 20 years that you see now the global trade, shrinking. So for the last 9 months now, we have less trade between all the countries around the world that we have in the previous year. This is the first in 20 years. So all this trade tension with Mr. Trump go with additional tariff, and China, in fact, go with retaliation. They no longer buy some product of U.S. farmer, and they devaluate their currency, and they have a fear out there that this trade war shifting from bad to worse, shifting to currency war as well. So this is something that no complacency. We have to remain a little bit more cautious. And I explained earlier, this is the first time that I gave 35% probability of a recession since I joined IA. So the good news is 35% is an alternative scenario. The 65 is still that the market will the economy will still continue to grow. The reason that we think that we will avoid a recession is the fact that central banks have to go coordination, synchronize interest rate cut. Since inflation is very low, so the central banks have the opportunity to rate cut. The Fed has already shifted 180 degrees. They are start to ease, and we see more easing to come. Even we have some countries like India who reduce interest rate, New Zealand, and many other countries. So, but this is something to watch because this is the first time in history that you have on the bond market 1/3 of the global bond market around the world who have negative rates. What that mean, negative rates for a bond market with 10-year maturity? That means that you finance the French government or, for example, the German government, and you will have less money at the end after 10 years after our financing the government. So this is very unusual. That reflects the fact that we have a difficulty with this worldwide economy, and in addition, the fact that the Germany do not use their fiscal tool. So we will see. And the reason that interest rate drops so much in North America is because by default, the interest rate in Canada, the bond market in North America are so attractive since we have negative rates overseas. So that's the reason we have seen a huge deceleration and huge decline of interest rate. A 10-year bond yield in U.S. was 100 basis points higher at the beginning of this year. So what a return. As a matter of fact, long treasuries, long bonds has performed better than the S&P 500. It's something to watch. So bottom line, we see a significant deceleration in the worldwide economy. It's important that the central banks will ease more to prevent a recession, and it will be important as well that Mr. Trump and China and U.S. Go more with an agreement, and sooner will be better because we have a lot of headwind. What we do in the investment strategy in such situation, keep in mind that as we speak, despite all the volatility, the concern, the market is still up 13-14% year to date. If you check Wall Street, for example, the S&P 500. So I have never seen people losing money by taking profits. And this is my first recommendation. No complacency, because 35% polarization is still important. So we suggest people to become more cautious, not to liquidate everything. No, it's to scale down a little bit the exposure in equities, or if you want, keep the same exposure to go with more defensive names like utilities, for example, who provide you a good dividend. We include as well gold. We have bullion. I manage 7 billions with IA, and we have include the bullion. So we have a 3-4% bullion in our diversified funds, because bullion have this characteristic to reduce the volatility, because bullion do not offer any coupon, any dividend. But guess what? When you have 1/3 of global market who have negative rates, the opportunity cost is very low. So that's the reason that we have some bullion in the portfolio. So at the end, it's important, the best investment is the investment you can sleep with. So that's the reason we recommend take some profit, to be a little bit more cautious. But since all of us are different, okay, your time horizon is different than mine. In fact, your risk tolerance are different as well. We invite you to consult your advisor to revisit their portfolio in such environment they have changed. And we have some people that are here who can help you. So on that note, I invite you to listen and watch the webinar that attached to this Facebook, and you could have more support. And thank you for your support, and we wish you a very good day.